So the purpose of this lecture is to go through the process whereby the information related to events that have happened to the firm find their way into the financial statements through the accounting system. Now, everything begins up here with the economic event that transpires. We buy something, we sell something, we pay someone, someone pays us, things along those lines. And honestly, the hardest work to be done is the interpretation right here. As we saw from the conceptual framework, the way we define assets and liabilities are not necessarily the same way that other people define assets and liabilities, and the same thing for revenues and expenses. Most of what we're going to do in BUA 400 is relatively simple, things that the interpretation is not that terribly difficult. However, as business transactions become more complex, the interpretation becomes more difficult, and that's where the accountant really earns their money. So the event happens, we figure out what it is that happened, an asset went up or an asset went down, and we book our daily journal entries. These are the debits and credits we're going to learn about later on. Now, in addition to booking the journal entries in our general journal, we also post to our T account, our general ledger, and we refer to them as T accounts because they look like this. They've got a left side and a right side. They look like a T. It's a little slanted, but that's okay. The idea being, of course, that while our general journal will keep track of each individual transaction as it happens, our general ledger will keep the running tally. So if we want to know how much cash we've got or how much someone owes us, we can look at the general ledger rather than hunting through each individual transaction in the general journal. Now, at the end of the year, the company goes through the closing process, a process that may take several days, perhaps a week or more. And actually, the closing is not the hard part. The closing is actually the easiest part of the entire process. What takes the most effort in the closing process has to do with our adjusting entries. At the end of the year, we recognize that not everything important to the economics of the company happened in a daily transaction where we are buying and selling goods and services, for instance. Rather, we recognize that the simple passage of time will often cause things to be true. For instance, if we borrow money, as time passes, we accrue interest. So at the end of the period, we will also book entries for these adjustments that we need to make and post them to the T accounts. Once that has been done, then all there really is left to do is to close the books. And between the closing process and what's left in the accounts after we've closed the books, that will give us what we need for our financial statements, our income statement, our balance sheet, our statement of retained earnings or statement of stockholders' equity, and our statement of cash flows. So let's do some transactions. Daveco, our fictitious company, was opened on July 1st, 2009 with a $100,000 cash infusion. We issued stock. Subsequently, we bought some stuff, we made some payments, we collected some money, and so forth. Now, like I said, at the end of the period, we may discover that there are things that weren't reflected in our day-to-day transactions, such as interest, such as using up certain assets, such as depreciation on our equipment. And so in addition to those initial 7 items, we're going to do numbers 8, 9, and 10. Those are going to be our adjusting entries. Now, to introduce the effects of these transactions on our financial statements, we're going to use this worksheet. We're only going to use this once just to make sure that we can keep track of how all these transactions are affecting our financial statements. We see across the top here our fundamental accounting equation. There's our balance sheet. Assets equal our liabilities and stockholders' equity. This is, of course, always going to be true. We also have our revenues minus our expenses minus our dividends. Here is our income statement. And when we throw in the dividends, that's going to be our statement of retained earnings. Our retained earnings is, of course, defined as the sum total of all of our income, our revenues minus our expenses, minus what we have paid out to our shareholders in the form of dividends. We're also going to look at cash flow items as they come up, just so we can kind of keep an eye on them, though we'll spend an entire chapter on cash flows later on. So the first thing that we did was we issued that stock for cash, transaction 1. Now, one thing that I'm going to suggest that you always do, certainly when you're just starting out, is to always begin with the cash, because the cash is always the easiest part of the transaction. Either we wrote a check to someone or someone wrote a check to us. It's really not that complicated. So in this case, we received a check for $100,000, and so our cash account has now gone up by $100,000. Our equation over here on the left-hand side has increased by $100. And so there are two things that can happen in order to keep our account balanced. We could either have a negative 100 over on this side, or we could have a plus 100 over on this side. If we leave it just as is, our accounting equation will no longer balance, and that's not a good thing. So the question, of course, becomes, well, if we've got this $100, whose $100 is this? Is this the bank's $100? Is this like the mortgage on Dave's house? Or is this actually Dave's money? And the answer is, of course, this is Dave's money. This is the owner's money. There's only one person in the equation, those are our owners, and so the money is going to increase our stockholders' equity. Specifically, when shareholders put money into the business, we call that common stock, and so we're going to have an increase in our common stock over on the right-hand side. Our left side equals our right side, and our equation is balanced. As it happens, this is a financing cash flow activity. Remember, we've got our operating, investing, and financing sections in our cash flow statement. This would qualify as a financing activity. The second thing we did was we went out and we bought a truck, and we wrote a check for $10 or $10,000. Now, writing a check means cash goes down, right? Cash goes down by $10,000, and now we need to make our equation balance. Now, what did we get for the $10,000? We got a piece of equipment, right? We got that truck. But now, the question is, did we get $10,000 of truck? I don't think so. We wrote a check for $10,000, but if someone were to ask you, say, how much did that truck cost? The answer wouldn't be 10, the answer would actually be 50,000, wouldn't it? Whenever you've gone out and bought a car, you might have put a down payment down and financed the rest. You hadn't bought a $2,000 car. You bought a $20,000 car with $2,000 down. So now this is a little weird, right? Because we've got two items in our transaction already. We've got a minus 10 and we've got a plus 50, both over here on the left-hand side. Our equation doesn't balance even though we've got the two items in it. Of course, we're going to have to add a third. We're going to have to add $40,000 over here on the right-hand side of the equation so that we'll end up being in a net 40 on both the left and the right. Now, when we borrow money and we sign a loan, well, we call that a note payable. These are typically long-term. They don't have to be, but they're typically long-term. If we're going to go to the effort of signing a note, it's probably going to be for a longer-term financing. We're going to put our $40 over here in our note payable, and now our equation is balanced. What kind of cash flow activity is this? Well, dealing with our long-term assets, that's an investing activity. It's worth noting that this is only a $10,000 investing activity because the cash flow statement, remember, only has to do with the cash. And if we only wrote a check for $10,000, our cash flow statement is only going to reflect $10,000 as well. Okay, transaction 3. We're writing another check. We're writing a check to the landlord for 12 grand, and we'll go ahead and put the negative 12 in. And now here comes the first thing that's going to require a little bit of thinking. What is going to be the other half of this $12,000? We've written a check, the money's gone out the door. It might be enticing to call this an expense because we are in fact $12,000 poorer, at least in the cash department. We've got $12,000 less cash. But now, if you remember the conceptual framework The conceptual framework says that we recognize revenues when earned, and we recognize expenses in order to match with our revenues. Now, the $12,000 that we spent hasn't actually gone away. The cash is gone, certainly. But I would argue, and an accountant would argue, that this $12,000 actually bought us something. What it bought us was the right to use this facility for the next 2 years. And over the next 2 years, as we use this facility, we're going to be generating revenue. And so the upshot of this is that rather than calling it an expense, we're going to come over here and we're going to call it an asset. We have prepaid our rent, we have bought a $12,000 asset, and we will expense this only as we use it in order to generate revenue. Now, you might be wondering, well, why do we call this an asset? Is it really an asset? And one way that you might want to think about this is, well, has the other guy done everything for us that they have to? What happens if the warehouse burns down? If the warehouse burns down, we get our $12,000 back, don't we? Because they promised that they would let us use this building for the period of 2 years. And if they can't come through with it, well, we're going to get our money back. And so we have received a promise for something, either 2 years worth of rent or our $12,000 back, one or the other. This is absolutely an asset. This is going to be an operating activity on our cash flow statement. All right, then what happened? Number 4, we're finally going to get to do some work. We're finally going to send out a bill. And we send out a bill for 40 grand. Why? Well, because we did some work. And here's our trigger. We say we did work. Haha, we know from the conceptual framework that when we do work, we have revenue. We should recognize $40,000 of revenue. But wait a minute. We didn't get paid yet. Are we supposed to recognize revenue even though we haven't been paid? And the answer to that is, of course, yes. That within the accrual accounting system, the timing of the cash flow is rarely important to the outcome on the income statement. We provided $40,000 worth of services, therefore we have generated $40,000 worth of revenue. Ideally, they would have paid us. That would have been awesome, but as it happens, they didn't, so we can't put that there. And yet, what does that mean? That means that they haven't paid us, therefore they owe us, and so we're going to recognize an accounts receivable. This is accounts receivable to recognize the fact that our customers owe us some money. We've got revenue, even though we haven't been paid. That happens every day. That is one of the hallmarks of accrual accounting. As it happens, if we were to look at this from a cash flow perspective, there's nothing on the cash flow statement. Because once again, if it's not affecting our cash, it's not affecting our cash flow statement. And so this is a non-cash flow activity. It doesn't go on the cash flow statement. Now, number 5 comes along, and hey, it looks like our customers paid us. Ka-ching, ka-ching, woohoo! $30,000 of cash has come in. And now what are we going to do with the $30,000? Again, it may be enticing to jump straight to the income statement and say, woohoo, we got $30,000. But if we put that there, something's not right, is it? That they pay us that $30,000 not because we did more work. We've only done $40,000 of work. They gave us that $30,000 not because we did more work. They gave us the $30,000 because they owed us. And so in this case, the cash is going to come in, not be recognized as revenue. In fact, it will actually be a reduction in our accounts. And so we have solved the timing issue of whether the check arrives on December 31st or the check arrives on January 1st. We say the timing of the check doesn't matter. We recognize the revenue when the work is done. And then when the cash comes in, all we're doing is settling up what we know we're already owed. This is, of course, an operating activity on the cash flow statement. dealing with our customers is, of course, an operating activity. So now we move on to number 6. And as it happens, doing work doesn't often come for free. We usually have to pay someone. And in fact, that's what we did. We had to pay our employees $25,000. And so our cash has gone down by $25,000. That's the easy part. And then what's the hard part? Well, it's not really that hard either, because we know that we've got $25,000 less on the left. We're going to have $25,000 less over here on the right. Where can that $25,000 go in order to balance things out? Well, it can't be paying off a liability, because the only liability we have is to the bank, and paying our employees isn't going to satisfy Citibank. So this $25,000 is going to have to be a reduction in equity, and this makes sense, doesn't it? This is going to be a reduction in our net income by an increase in expenses, because of course we weren't really $40,000 richer. We generated $40,000 in revenue, but that $40,000 of revenue cost us 25 grand to make. In fact, we're only $15,000 to the happy. And this should be no surprise. We recognize this as an expense because we're paying them for the work that they have already done. Were we paying them for work that they were going to do, had we given them an advance, well, we'd be doing something very similar to our prepaid rent. This, as well, is going to be an operating activity. Okay, number 7. Another check comes in, and we do the easy part first. The $15,000 of cash has come in, and we immediately go, woohoo, we're rich, yeah, let's go to Vegas, until someone points out that it seems like we're an awful lot like our landlord from number 3. Back in number 3, we wrote a check to our landlord and said, Mr. Landlord, you either give us 2 years worth of rent or you give us our money back. Well, now we have taken the position of the landlord, haven't we? We've received $15,000 in cash from a customer, but we haven't done the work yet, right? And if we haven't done the work yet, we know we don't get to call that revenue, because we only get to call it revenue when we've done the work. In fact, again, if we were to say this whole Dave Corp thing is a terrible idea, let's go ahead and shut down, what would we need to do with the 15 grand? We'd of course have to pay it back to our customers, wouldn't we? And so this $15,000, the increase over on the asset side, is going to be offset not by an increase in equity, because we are not any richer than we were before. It's going to be offset by a liability, specifically the liability that we call unearned revenue. The money has come in, and yet we have not earned it. It is unearned. And so this $15,000 is going to sit on our balance sheet as a $15,000 liability until such time as either we have done the work, hopefully next year, or we've given them their money back. So here we are at the end of the year. We've done all the transactions that we were going to do throughout the period, and yet we know that there are some things that still need to be dealt with, some things that aren't quite right yet. For instance, if you remember, way back when, we borrowed some money, right? We borrowed $40,000 at 10%. And at the time, we didn't bring up the 10%. Because at the time, no time had passed, there was no reason to recognize any interest. And yet, when we fast forward from July 1st to December 31st, what do we discover? 6 months have gone past. Now, if we're going to build a balance sheet today, and that is in fact our goal, we're going to create a balance sheet for December 31st, 2009, we need to recognize the fact that we owe the bank more than just the $40,000 that we borrowed. If we walked into Citibank and said, here's your 40 grand back, the banker would say, thank you, I appreciate that, that was the principal, and yet you've had my money for 6 months. And the deal typically is, if you have my money for a period of time, you give me a little bit more than the principal. That's the entire idea behind interest. And so we have to recognize that even though we're not writing a check, even though we might not write a check until next June 30th, we're still on the hook for 6 months worth of interest. And so we're going to have to recognize that. We've got $40,000 of debt at a 10% interest rate. We've had their money for 6 months. We're going to have $2,000 of interest expense. Interest expense on the income statement, we're $2,000 poorer than we were. Obviously, we didn't write them a check. If we had written them a check, it would have been out of cash, and it would have been one of our initial transactions. And yet we know that we're on the hook for the $2,000. We haven't paid them yet, which means we owe them. And if we owe them, that's a payable. The other half of the transaction is going to be to increase our interest payable by $2,000. So now we've seen a whole bunch of things. We've seen a transaction that was one on the left, one on the right. We've seen one that had more than one on the left and one on the right. We've seen a transaction that was entirely over on the left-hand side. We see a transaction that's entirely on the right-hand side. It doesn't matter what the combination is, so long as when all is said and done, if we draw a line right down the middle here, our total left equals our total right. Oh, and this was an operating activity. Sorry. The next thing that we have to recognize also has to do with the passage of time. Adjusting entries almost always have to do with the passing of time. And that has to do with this guy up here. Back on July 1st, we wrote our landlord a check for $12,000 to give us the use of this facility for the next 24 months. And what's happened? Well, 6 of those months have gone past. And so while we originally recognized a $12,000 asset, recognizing 24 months worth of asset, here we are at the end of the year, we don't have 24 months of asset left. We've only got 18 months of asset left. We've used up 1/4 of our prepaid rent. If we were to put on our balance sheet that we had $12,000 of asset, that would be a lie. It would be a dirty, stinking lie, as it happens. And so what do? We're going to have to reduce the amount of our prepaid rent by $3,000, recognizing that 6 months have passed. Where did it go? Well, that $3,000 is now gone, right? We used to have an asset of 12. We've now got an asset of 9. The $3,000 is gone. And where did it go? Well, it went to the production of revenue, didn't it? That if we didn't have the facility, we couldn't have run our business. We couldn't have sent out bills. We couldn't have generated revenue. And so this $3,000 is a reduction in equity via the income statement as an expense. Okay? Just to be clear, I've got a -3 over here and I've got a +3 over here. This is really a -3 because this negative extends into it. Okay? So don't be confused. This is a -3 on the left. This is also a -3 over on the right. It's just simply the way that it looks. Item 10, the last adjustment that we have to make, is the exact same thing as the prepaid rent, except just a little bit different. That just like with our prepaid rent, we bought a great big asset and that we are expensing over time, when we bought our great big piece of equipment, we're going to do the same thing. We're going to expense it over time. And that's what the process of depreciation is. The process of depreciation is taking this upfront cost and allocating it into the income statement to match with the revenues as we earn them. The exact same way that we call this an asset and we expense it over time as well. It's going to be a little trickier in that I've introduced the idea of $10,000 of salvage value. Our asset cost us $50,000, but if we expect to get $10,000 back, the true cost of our asset is only $40,000, right? And so if we wanted to recognize in the income statement the true cost of owning this equipment over the long term, we would expense not all 50 grand, we would expense only the 40 grand of true cost after we've taken out the salvage. We'll talk more about this much later on. I just wanted to introduce to you the idea of depreciation now, because why not? It's the exact same thing as prepaid rent. If you understand prepaid rent, you understand depreciation. The calculations can be a little hairier, and like I said, we will cover those much later on in the course, but at least for right now, understanding what depreciation is, this is as good a time as any to do so. So we've got $40,000 of cost. We expect this truck to last us for 4 years. And so what have we got? $10,000 a year. We've used it for 6 months. And we've got $5,000 of expense and $5,000 reduction in the asset. We're going to see when we do the journal entry that we're not actually going to reduce the equipment account, but for right now, this is good enough. So let's do a quick recap. We increased an asset, that is the accounts receivable, when we performed a service. That's revenue. We didn't wait for the cash to come in. The actual revenue recognition was treated as separate transaction from revenue realization. Recognition means going on the income statement. Realization meaning having to do with cash. The cash flow didn't matter. What else did we do? We wrote a check. We made a payment for rent for $12,000, and we didn't call it an expense, even though we wrote a great big fat check, because it isn't an expense yet. Until we actually use it in the process of revenue generation, it sits on our balance sheet as an asset. So we see an example of a future economic benefit resulting from a past transaction. An asset is not necessarily a table or a chair or a computer or cash. An asset is a much more conceptual item. Rent, of course, isn't the only thing that this happens to. We can have prepaid insurance. In fact, we almost always do. When we buy supplies for the photocopier, we call that an asset, but until we use it. Anything that you can pay for as an expense, you can prepay and call it an asset. On the liability side, we received a payment from a customer. And this was, of course, not revenue, because we hadn't yet earned it. One of these days, it'll become revenue. But until then, we owe our customer that work or that money. We call it a liability. Further, we did the same thing for interest. We know we're on the hook for it. We know we owe Citibank more than just the 40 grand they lent us, but we're not going to be writing a check until some point in the future. So we've got two examples of liabilities, future economic sacrifices that come as a result of past transaction. Just like with assets, liabilities are a little bit more all-encompassing than you might think. There are other things we know we owe, even though the future payment might be uncertain. For instance, if we sell a product with a warranty, well, we owe our customers warranty work. If we sell products with box tops for education, we owe a bunch of schools some money. And of course, if we get sued, at a certain point, the lawyers are going to tell us, you know what, you're going to lose it. We need to put this thing on the balance sheet, even though it might not have completely resolved. So now is not a bad time to take a little break. Review what we just did, make sure that you truly understand what was going on with each of those transactions and how they affected the accounting equation. Like I said up front, that's really the hard part. Understanding the nature of any particular transaction, that's where the accountants really have to use their intellect. Beyond that, the debits and the credits, which will be the next part of this, that's simple. The trick is, of course, knowing what to debit or to credit, and that's what we were just doing. So now that we've gone through and interpreted each of the individual transactions, we can now go ahead and put them into the accounting system. This is called the double entry bookkeeping system because each transaction has two parts to it, a left side and a right side. The system has been relatively unchanged for hundreds and hundreds of years. It really works that well. Note that what we are about to do doesn't change anything that we have already done. We have recognized that a liability needs to go up, or an asset needs to go down, or something along those lines. We're simply putting it in a different format Rather than using that great big honkin' worksheet, we're able to convey information in a somewhat more efficient manner. Now pay attention to the next two slides, because this is where the trick is. Once we get our minds around these next two slides, and actually it's even just the second slide after this one, everything is easy going forward after that. So how do we journalize economic activity? Well, the steps 1, 2, and 3 are part of the interpretation, and this is what we just did. We identify which particular accounts need to be adjusted. Perhaps our cash has gone up or down, or perhaps our payables have gone up or down. We know what direction they are, and we calculate the dollar value of the change. Most of the time it's obvious. Sometimes it takes a little work, but most of the time it's really not that difficult to do steps 1, 2, and 3. This then, of course, brings us to our friend the journal entry box. Now, what's really nice about the journal entry box is that it overlays two systems of keeping track of things, two systems that both have lefts and right. You'll notice up on top, we've got our assets are equal to our liabilities and our owner's equity. We have a left side of our equation, and we have a right side of our equation. Similarly, we're going to introduce these two words, the word debit, which means left, and the word credit, which means right. And those are the only things that those mean. You used to think you knew what the word debit means, and forget about it. Debit means left, and that's all there is. Now, when we overlay these two sets of lefts and rights, one which is a static, we've got an asset on the left and our liabilities and owner's equity on the right, these are, and we then take our debits and credits and we make those directional lefts and rights, we can now make our lefts and rights up in our equation change. Let's say I've got an asset, for instance cash, and I want to make my cash account go up. Well, cash, being an asset, lives on the left-hand side of the equation. If I want more left, it seems to me intuitive that we would add in some extra left. It's almost like when you made lemonade as a kid. You put in your water, but then you've got your sugar and you've got your lemon juice. And if, once you've taken a sip of your lemonade, you decide that you need it to be sweeter, you add more sweet. If you want it to be more sour, you add more sour. If you want it to be less sour, well, you can't take away sour. What do? You add more sweet. Right? So we've got sweet and sour essentially being our left and right. So when I've got my left, my sweet, for instance, and I want to make it sweeter, I'm going to add in some more left because debit is equal to left. When I debit an asset, because debiting means left, I'm making my asset go up. Similarly, over on the right-hand side of the equation, let's say this is our sour. If I want my lemonade to become more sour, I want it to be more right. What am I going to do? I'm going to write it. And so when I credit a liability or an owner's equity account, that is indeed making it go up. So if we turn to our opposite words over here, we can extend the lemonade example. If my lemonade is too sweet, I can't unsweet it, right? I can't unleft. What do? I mix in a little bit of right, I mix in a little bit of lemon juice. And so if I want to have less cash, cash is an asset, asset lives on the left side of the equation, I can't unleft it. What do? I write it. And if I've got too much right, I want to make my liability account go down or my owner's equity account go down, well, I'm going to want to left it. That right plus left is a little bit less right. Now you are no doubt thinking to yourself, but Dave, I know what debit means. When I look at my account, when I look at my bank account and I see a debit to my account, well, that's a bad thing, isn't it? And I see a credit to my account, that's a good thing. And that totally doesn't jive with what you just told me. When my account gets debited, my bank account gets debited, that means I've got less cash. Why is it that that seems to be the way that it works? And the answer comes down to frame of reference, that you do not have an accounting system. Sure, you've got a checkbook, but you don't have an accounting system with debits and credits and so forth. The bank, however, does. Now think about what that bank account is to the bank. They've got your cash, but they owe you that money, don't they? They owe you whatever happens to be in that account, and they owe is the definition of a liability, isn't it? Your bank account is a liability to the banker. So when they debit your account, and that reduces how much cash is in your account, what's happening? They're decreasing what they owe you. They've decreased their liability. Similarly, when a company extends store credit to you, well, what are they doing? You've returned that ugly sweater that Great Aunt Marge gave you for Christmas. You didn't have the receipt, though, so they give you store credit. They owe you. They have promised to provide you goods and services. That's what that unearned revenue was in the example that we just did with Daveco. They have your money. They owe you goods and services. They owe, that's a liability. When they owe you, they're going to credit your account or give you store credit. So that's why you think you know what debits and credits mean, but you don't really, because you've been thinking about them all from the wrong frame of reference. You selfish bastards. So now let's go back through our transactions. As I said before, nothing has changed except the framework. So I'm going to move relatively quickly over the interpretation of the transactions. Ideally, you took the moment to pause to spend some time making sure that you understood how all of that stuff worked. So Daveco opened its doors by issuing stock for $100,000 in cash on July 1st, 2009. And we know that we've got two accounts that are being changed, our cash account and our common stock account. Here, we can see our T accounts. We've got a left side and a right side with the line down the middle. All T accounts look the same way. They've all got a left and a right. But which side the ending balance will be on will differ depending on whether or not we've got an asset, a liability, an equity, a revenue, or so forth. So our first transaction has cash going up. Cash is an asset. Assets live on the left side of the equation. And so if we want more left, what do? We left it. And that means debit. So we're going to debit our cash for $100. Our common stock account is an equity account. We have more common stock. We have our common stock going up by $100. Common stock being an owner's equity account. Owner's equity lives on the right-hand side of the equation, and so we're going to want our common stock account to be credited for $100. And if we're good little doobies, we'll write this in as well to record the issuance of stock for cash. Now, a couple of notes about the journal entry. The first is that the debits are always on the top, the credits are always on the bottom, and the credits are indented a little bit. We do this by convention, and it's certainly worth doing while you are practicing in BUA 400. Ultimately, I don't really care what your journal entries look like. As I've said before, I'm not turning you into a bookkeeper, so whether or not your bookkeeping is particularly pretty is of no consequence to me whatsoever. However, if you've got simply a wall of text when you're taking notes or working on a problem, and it's all left justified like that, it's going to be very difficult for you to read as you're going back through your notes. So I would suggest that you follow along with the normal format of journal entries. Debits always on top, credits always on bottom. What else did I put in this journal entry? I've got our little A plus over here and owner's equity plus over here. I put that in. I learned how to do that early on in my teaching career to suggest that students do that just as an extra self-check. That having debited cash for $100, debiting cash makes an asset go up, and it's just one extra little self-check. Do I really want an asset to go up? Because when I debit cash, that's indeed what's happening. Yep, that's exactly what I want, and so we're happy. You may find yourself putting something in that doesn't work out, and when you put in that little designator, say a liability going down or a revenue going down or something along those lines, you'll look at it and you'll say, no, that doesn't make any sense. I don't think I want to do that. I'm going to change what I'm going to put into my journal entry. As I mentioned before, doing the cash first makes the journal entry much easier because we know that just like we have a left and a right in our equation, and the left and the right always need to be balanced, we have a left and a right in our journal entry, and the left and the right in the journal entry always have to be balanced as well. So having put the $100 in the debit side for our cash account to begin with, And knowing that we have to adjust our common stock account as being the other account in the transaction, there is one and only one thing that we can do to make our journal entry balance, and that was to credit it for $100. So this is the benefit of doing cash first. It often makes the other half of the journal entry obvious, even if you had no idea whatsoever what the common stock account was and whether or not it should be debited or credited to make it go up. We come to the conclusion that it must be credited because that's the only thing we can do. Our second journal entry involves our purchasing our equipment for $50,000 by paying cash and signing that note. So we've got our cash, our equipment, and our note payable. You will see in our cash account that the $100 has been grayed out. In your cash T account, you should see the $100 already there. As you're following along, the T accounts will always have in the light gray the numbers that should already be there. And if your T accounts don't jive with my T accounts, then you need to figure out where things went wrong and get them fixed. Otherwise, everything falls apart. Now, we decided that we're going to begin by decreasing our cash by $10. So you'll note that there's a credit in here. Now, of course, every journal entry has to have at least one debit, so please leave room. There should be at least one space up here for your debit, because even though we're going to do cash first, that's always the right thing to do, we do want to make sure that there's room for our debit, whatever that debit ends up happening to be. Now, as we decided, the $10 that we spent was buying our piece of equipment which we all agreed was going to be a $50,000 piece of equipment. Equipment is an asset. Assets go up on the debit side, and so we're going to debit our equipment. Once again, we see that our journal entry is not balanced. We see that we've got $50,000 over on the left-hand side of the equation. We've got $10,000 over on the right side of the equation. And so that means we need another $40,000 over on the right. As it happens, we've got a note payable being a liability account. Liabilities live on the right side of the equation. We owe the bank more money than we used to. We need to make our note payable, our liability, go up. And we make our liabilities go up with a credit. And so we're going to credit our liability for $40,000. And we're going to put in our little memo to record the purchase of land for cash and note payable. Again, you can do that if you'd like. You don't have to do that. There are few enough transactions that we're unlikely to get lost and get confused when looking at any particular journal entry. But I like to put it in there just for completeness' sake. Our third journal entry also involves a cash transaction. So our cash, which is now at a balance of $90,000 if we wanted to create a balance sheet today. And the other side of the transaction was that prepaid rent account. We recognize that even though we've written a check for cash, we have not in fact incurred an expense. We have bought something of value. So when we reduce our cash, cash is an asset, assets go down on the right. We credit our cash account, and there's our asset going down. We're going to debit our prepaid rent account. Our prepaid rent being a prepaid, this means it's an asset. And assets go up on the left. We're going to debit our prepaid rent on the left and record our prepayment of rent. Number 4. We send out some bills to customers for consulting revenue performed throughout the year. And this is a composite transaction. We sent out lots and lots of bills. We're only going to do the journal entry once because doing it once is plenty for our purposes. We know that our accounts receivable are going up. Our customers owe us some money. And why do they owe us some money? They owe us some money because we did work. And when we do work, we call that revenue. There's no cash in this transaction. Curses! So we can't start with that one first. However, we can look at our accounts receivable, which we know is an asset, and begin with that one. We have more accounts receivable. We know what to do with an asset account when we've got more of it. More assets means a debit, and so we're going to begin by debiting our accounts receivable for $40,000. Once again, this allows us to draw a little line here and infer what the other side of the transaction is going to be, this is going to have to be a credit to our revenue account, because otherwise our journal entry wouldn't balance. And so there's our credit to the revenue account, making owner's equity go up. Now, a quick note, our revenue account is not an owner's equity account. That is, it's not on the balance sheet. But what do we know happens? We know that our revenues minus our expenses are equal to net income, right? And net income belongs to the owners. Net income goes to live in retained earnings when all is said and done. So when we increase our revenue account, when we credit our revenue account, we are in fact crediting owner's equity, but ultimately via the income statement. That $40,000 of revenue will become net income. Net income will become retained earnings. Retained earnings is an owner's equity account. And so crediting revenue is, in fact, crediting owner's equity. This is the way that we are then able to keep our equation in balance between our left side and our right side of our equation without putting it directly into retained earnings. In fact, the only time we will ever do anything with retained earnings will be during the closing process, never during the actual year. To record billing customers for services provided, and we can move on. We're then paid. Yay, we're back to cash. And our cash should now have 3 numbers in it. If our cash account doesn't have 3 numbers in it, then we are wrong. And once again, as we decided back when we did the interpretation, the fact that we received cash doesn't mean we have more revenue. We've already recognized the revenue. That increase in cash is going to be associated with a reduction in our accounts receivable. So cash has gone up. Cash is an asset. We debit our cash to make our cash go up. At the same time, however, our customers no longer owe us as much money. They used to owe us $40,000, but they paid some money off. They now owe us only $10,000. And so what do we have to do? We're going to have to credit our accounts receivable account, make our assets go down. We've exchanged one asset for another. We have a credit to accounts receivable for $30,000. Our equation is balanced with asset going up, asset going down. The entire transaction happens to be over on the left-hand side of the equation, and that's completely okay. Our journal entry has got a left and a right, and that's all we really need. To record collection of receivables from customers, and we can move on. So, we've written our employees a check. We've written our employees a check for 25 grand. We know that cash has gone down. And then we turn to the other half of the transaction and we say, well, what did we get by making this payment? And as it happens, we didn't get anything. What we're doing is we're making our employees whole for having come to work all this time. That our employees came to work allowed us to generate $40,000 of revenue, and in exchange for that, they are expecting to be paid themselves. And so we recognize the wage expense, the fact that we are actually a little bit poorer than we thought. We aren't, in fact, $40,000 richer because of that revenue. We are $40,000 minus $25,000 equals $15,000 richer because we incurred wage expense as part of the revenue generation process. We're going to leave the space for our debit because we're going to credit our cash first. And then we're going to debit our wage expense because, as we know, that's the only thing we can do, because we have got 25 over on the right-hand side and we want 25 over on the left-hand side. And so we're going to debit our wage expense for $25,000. Just like with the revenue, wage expense is not really an owner's equity account. Wage expense is not a balance sheet account. Owner's equity is a balance sheet account. Wage expense is an income statement account. But we are indeed reducing owner's equity, again, via the income statement. Because when net income becomes retained earnings, we didn't have $40,000 of net income. We had 40,000 minus 25 is equal to 15 of net income. And so every expense that we incur is reducing owner's equity via the income statement, ultimately reducing how much goes into our retained earnings account when all is said and done. To record the payment of wages, and we move on. So now we turn to number 7. Number 7 involved our receiving cash just as before, and our cash account is indeed going to be changed. On the other side of the equation, however, we have to recognize the fact that being paid this cash is different than the cash we had received in the past. In the past, when we received the cash, it was because our customers already owed us for work that we had already done. In this case, we received cash for work that we're supposed to do at some point in the future. And so, as we discovered earlier on, what that means is not that we've become $15,000 richer, but instead, we owe our customers $15,000. This is, as we mentioned before, a liability account. The unearned part means that we are on the hook. We owe our customers either their $15,000 back, or better, doing the work so that we don't have to give them the $15,000 back. We debit cash for $15,000 because assets go up on the left. Our unearned revenue account, which is a liability account, liabilities go up on the right. We're going to credit our unearned revenue account. We're going to write to record receipt of advance from customer if we are so inclined. And we are now done with the journal entries that happened throughout the period. This leaves us to something called the trial balance. If you were to total up all of your T accounts, and I encourage you to do so just to make sure that you didn't miss anything, these would be the balances that are in those accounts. So the purpose of the trial balance is to make sure we didn't screw anything up during the initial journalization process. All of our debit accounts are listed over here. All of our credit accounts are listed over here. When we add them all up, we look to see whether or not they're equal to each other. If they're not, what that means is that either one of our journal entries didn't balance or we didn't post properly to the T accounts. Modern accounting systems don't require you to do this anymore. They won't let you put a journal entry in that doesn't balance, and they will automatically post to the proper things. But since we're doing this on pencil and paper, it may be worth doing just for the sake of keeping track to make sure we didn't screw anything up. Having made sure that we haven't made any mistakes during the initial journal process, we're now going to turn to our adjusting entries, of which we had 3. The first was the recognition of interest expense. Once again, to remind you of the math, we had a $40,000 loan at a 10% interest rate, which means that we owe the bank $4,000 per year in interest. Let's say it's payable annually. However, despite the fact that we don't have to write a check today, we recognize that we are on the hook for 6 months worth because we borrowed the money back on July 1st and now it's December 31st. We need to recognize $2,000 of interest for our December 31st, 2009 financial statements. We recognize a reduction in equity because of our interest expense. And because we haven't actually written the check, because we owe the bank, we recognize it as interest payable, not as a reduction in cash. Interest expense makes owner's equity go down. Expenses make owner's equity go down. Owner's equity goes down with a debit. Very good, assuming you got it right. I'll give you the benefit of the doubt. We're going to debit our interest expense for $2,000, and of course, payables being liabilities go up on the right-hand side of the equation. We're going to credit our interest payable for 2 to record the accrued interest expense. The word accrued, of course, means recognized, oh, my handwriting is terrible, on the income statement before the cash flow. That's what that says, I promise you. When we accrue something, we're putting it on the income statement even though the cash flow hasn't happened yet. The second adjustment that we had to do was recognizing that we had used the rental facility. Way back when, we had debited prepaid rent for $12,000 when we credited the cash, saying this isn't rent expense, it's not rent expense until we actually use it. For now, it's just an asset. Well, guess what? We've used it. And so where did that money go? Well, it went into rent expense. Of course, our $12,000 was for 2 years, and we have used 1/2 of a year. And so we have used $3,000 worth of prepaid rent. We're going to reduce our prepaid rent by $3,000. What does this do? Well, on the balance sheet side, it shows the world that we're really only owed $9,000 in prepaid rent. We've only got a year and a half's worth of rental facility available to us before we have to re-up and pay again. On the income statement, what it shows is that we have incurred a cost of doing business, that some of the money that we spent is now lost and gone forever. And why did we spend it? Well, so that we could generate that $40,000 in revenue. This was simply one additional expense. To record the expiration of a portion of prepaid rent, or however we care to write it down, and we can move on. Our last transaction has to do with our depreciation expense. As I mentioned in the first part of the lecture, if you understand the concept behind the prepaid rent, you understand the concept behind the depreciation expense. It's the exact same thing. We face an upfront cost, which we capitalize, that is, we turn it into an asset, and then we expense over time as we gain the use of that asset. In this case, we had a piece of equipment that cost us $50,000. We had $10,000 of salvage value, giving us a true cost, we'll call this true cost, of $40,000. We've got a 4-year expected life, which means $10,000 per year. And if we've used the asset for half a year, that gives us $5,000. Oops. That gives us $5,000 of depreciation expense for the current year. So we recognize depreciation expense. Now, the difference between the way that we treat our prepaid rent and our depreciation expense is not in concept. They are conceptually identical. They have to do with how we account for them on the books. When we reduced our prepaid rent back here, we reduced our prepaid rent directly. 12 minus 3 is equal to 9. We accounted for it within the prepaid rent account itself. However, when we do this with depreciation, we are not going to use our equipment account. We're going to use a separate holding account that we call accumulated depreciation. Accumulated depreciation is what we call a contra asset account. We can have all sorts of contra accounts. This is a contra asset. That is, it lives with the assets. It lives on the left-hand side of the equation, but it carries a contrary balance. It acts in opposition to the underlying account. So when we depreciate our asset, we're going to debit depreciation expense for $5,000. We always debit our expenses. And we are going to credit not the equipment, we're going to credit this accumulated depreciation account. It's making our asset go down not because it's an asset account itself, but because when paired with our equipment account, the two of them together reduce the value of the underlying asset. On our balance sheet, if we wanted to see this, we would see on our balance sheet, we would say equipment of $50,000 minus accumulated depreciation of 5, giving us a net balance of $45,000. Just like with the prepaid rent, we're doing the 12 minus 3 is equal to 9. We're doing the 50 minus 5 is equal to 45. We're simply doing it in 2 accounts rather than in 1. If we wanted to look at it from a general ledger standpoint, we could look at it like this. Here's our equipment account. Here's our accumulated depreciation account. We've got 50 over here. We've got 5 over there. Together, they're a net 45 debit. Having done that, what do? Well, another trial balance just to make sure we didn't screw up any of our debits and credits during the adjustment process, and then we can move on to closing. The closing process does a couple of things. The first thing it does is that it recognizes actually in the owner's equity accounts on the balance sheet the activity that happened throughout the period. That is, we're going to finally adjust retained earnings for the net income and the dividends that might have been paid throughout the period. The second, equally important role is that it provides a nice, fresh, clean slate for us for next year. Whereas our balance sheets roll over from year to year, we go to bed on December 31st being owed a certain amount of money. When we wake up on January 1st, we're going to still be owed that amount of money. Our revenues and expenses are over a period of time. If we earned $1 million in revenue during 2009, and then we wake up on January 1st, 2010, how much revenue have we earned for the current year? Zero, right? We don't want that $1 million dragging over from one year to the next, and so we need to clear that thing out as well. Now, the way that I set up your general ledger was that all of the T accounts for the assets, liabilities, and equity, all of our balance sheet accounts, are up on the top, and all of our revenue and expense accounts are down on the bottom. And all of those bottom accounts need to get zeroed out. And so we've got revenues, and we've got a whole bunch of expenses, and these are what those accounts look like. Now, the closing process is a completely mechanical, no thought, no intuition, don't even think about it kind of process. The idea behind the closing process is that I have got an account, our revenue account, that I need to have closed. I need this account to have a zero balance so that when I wake up tomorrow, the start of our new fiscal year, we've got a brand new fresh account in order to use to book our current period revenues in. The same goes for all of our expenses. This year's wage expenses have nothing to do with next year's net income. So these have all got to be zeroed out. And how do we zero it out? Well, if I've got an account, my revenue account, with a credit balance of 40, what's the only way to give it a total balance of 0? Well, by debiting it for 40. And our wage expenses. Our wage expense has got a debit balance of 25, and I need it to have a net balance of 0. What do? I credit for 25, and I credit for 2, and I credit for 3, and I credit for 5, and now what have I done? I've done my housekeeping. All of my revenue and expense accounts have now been zeroed out and are all fresh and new for next year. You'll note, however, that our journal entry doesn't balance. Our journal entry has got 40 over here on the left and has got a total of 35 over here on the right. So our journal entry doesn't balance. We're going to need to put a plug in. We're going to have to put in whatever number in this box gets the journal entry to balance. I call that Dave's magic plug box. The number doesn't need to come from anywhere intuitive. It's simply the number that makes the journal entry balance. We plug the journal entry to that number. And so what we're going to do is we're going to create another temporary account just for a few moments called income summary, and we're going to put that $5,000 into our income summary account. Now, if you'll take a look at our journal entry for a moment, and if I were to, say, move this 40 over here and draw a line and put parentheses like this, all of a sudden, that looks like something pretty interesting, doesn't it? Revenues of $40,000 minus wage expense, minus interest expense, minus rent expense, minus depreciation expense equals 5. Well, what is that? That's net income, isn't it? That's net income. That journal entry right there has now given us all the information that we need to create our income statement. That's the purpose of closing entry number 1. It gives us all the information we need to create our income statement. Note that it is not an income statement. It's ugly. It's not formatted properly. But the information is there. When it comes time for us to do our income statement, all the data will come right from that journal entry. Our second journal entry, in this case, is going to finally take that net income and put it into retained earnings. Because our income summary account is also a temporary account. we also need this account to be zeroed out. And so we're going to want to zero it out where? Into retained earnings. I have got a net credit over here of $5,000 in our income summary account. So what am I going to do? I'm going to debit it. There's only one thing left to do, to credit our retained earnings for 5, and our books have been closed. Note that here is all of our net income for the year, our revenues minus all of our expenses. If we had had a dividend in the current period, we would have had an additional closing entry, and in fact we will in year 2 when we get to year 2. Having done that, we're left with one more trial balance. This is our post-closing trial balance. All of our revenues and expenses are gone. What does that mean? The only accounts that are left are balance sheet accounts. So when it comes time for us to create our balance sheet, all the information we need is right here. It will let us create our balance sheet. So financial statement time. Our balance sheet comes from the post-closing trial balance. Our income statement comes from the closing entry. We saw both of those already. Our statement of stockholders' equity comes from the common stock and retained earnings T accounts, because that's what the T account does, doesn't it? Our T accounts say beginning balance plus what changed equals our ending balance, which is the exact purpose of the statement of stockholders' equity or the statement of retained earnings. And our cash flow statement can come from the cash T account if we're going to do our cash flow statement in that manner. More about the cash flow statement to come. Here's our income statement, our $40,000 of service revenue, minus a bunch of operating expenses gives us operating income, minus our interest expense equals our net income. Here's our statement of stockholders' equity, our beginning balances, plus what happened, in this case a stock issuance, in this case we had net income, giving us an ending balance in all of our stockholders' equity accounts. Here's our balance sheet. Our total assets equal our total liabilities. Please note that those are not the same subtotals that came from the post-closing trial balance, because this guy over here is a credit. It would have been on the credit side of the post-closing trial balance, but lives on the left side, the debit side, the asset side of the balance sheet. So just be careful. Make sure that you're not confused about that. And then there's our cash flow statement. The cash received from clients. You'll note that this includes the $30,000 that we received because we had done work, and the $15,000 that we received for work that we have not yet done. Similarly, this $12,000 right here is the full $12,000 that we paid, even though we've only used up $3,000 worth of rent expense. That's the purpose of the cash flow statement, to record the actual cash that's come in or gone out the door. The income statement takes care of the accrual accounting. The cash flow statement is pure cash in, cash out. So once again, here's not a bad place to stop. We've gone through the entire accounting cycle for a full year, or at least a full period, for Daveco. I encourage you, rather than watching the rest of the lecture now, to stop and work through year 2 on your own. Do your best, and then come back and watch the lecture and see what you picked up and what you didn't pick up. Accounting is purely practice-based. The more you practice, the better you'll get at it, and the sooner you understand internally how the debits and the credits work, the more interesting the rest of the class is going to be, because once we move to Chapter 4, everything is going to be in a debit and credit framework. So welcome back. Time for us to finish up with year 2. There will be a couple of things that we're going to stop and spend some time on, but much of what we're going to do right now is just a rehash of what we did during the first 6 months of Daveco, and so we can probably move somewhat more quickly. So the first thing we did was we billed some customers for $60,000 of work during 2010. This is a journal entry very similar to the journal entry we did before. We know that it involves our accounts receivable account, and we know that it includes our revenue account as well. Now, one thing to point out is the fact that this guy right here has got an opening balance, and this guy does not. That is, of course, because of the closing process. Our revenue got closed into retained earnings as part of our closing entries, whereas our accounts receivable, being a balance sheet account, rolls over from year to year. So in your packet, the very first thing you should do is copy over all the numbers from the post-closing trial balance into our new general ledger, our new T accounts, so that we've got those initial balances rolling forward. Having performed revenue on account, we know that we're going to debit our accounts receivable. Accounts receivable is an asset. We're going to credit our revenue. That's an increase in owner's equity via the income statement. We put our little notation in there to record billing for customers for services provided, and we move to the next journal entry. So then we're receiving $65,000 in cash from the customers we previously billed. And here's where, if we hadn't copied those numbers over from the prior year's post-closing trial balance, we would have found ourselves in some trouble. Because while we're receiving cash, the other side of the journal entry is, of course, our accounts receivable. Now, if we hadn't included the $10,000 initial balance, and we tried to collect $65,000 in cash off of our accounts receivable, there'd clearly be a problem there, wouldn't there? So it's very important for us to recognize that we are in fact now owed a total of $70,000, not just the 10 or not just the 60. We received cash. Cash is an asset. Asset goes up with a debit, so we debit our cash. We credit our accounts receivable to record the collection of receivables from customers, and journal entry 2 is now done. Journal entry 3, again, is very similar to one that we did in the prior period, the only difference being the number. Last year we had $25,000 in salaries. This year we've got $26,000. And so we're going to have a decrease in cash, leaving room for our debit, a debit to wage expense for $26,000. Just a quick little note that we've got salary expense, we've got wage expense. They're essentially the same thing. I'll sometimes go back and forth, mostly because I don't really notice I'm doing it. So if you hear something that's like that, that seems a little bit off, wage expense versus salary expense, it's probably just because I used a different term for something, and I apologize for that up front. We record our payment of wages, and on we go. So number 4 is an interesting one. Here we are, let's say that this is June 30th, 2010, and we're now making our annual payment on the note. And so, just to remind you of what happened, we had $40,000 of debt from that piece of equipment that we bought, and we're being charged a 10% interest rate. So if we have their money for an entire year, they deserve $4,000. We should have to pay them $4,000. And so, of course, our cash account is going to come into play. We're writing them a check for $4,000. Interestingly, though, you may notice that we've got 2 T accounts up here on the page, suggesting that there are 2 things that are going to be included in the journal entry in addition to cash. And of course, this comes down to the question, well, why are we paying them? And the reason why we're paying them $4,000 has to do with 2 things. If we were to look at a timeline here from July 1st of 2009 to June 30th of 2010, with a 12/31 break in the middle, that this is the period over which we've had their money, right? And this is the period over which they deserve $4,000. So when we pay them the $4,000, we're paying them for the money that we have had of theirs for this period of time and for this period of time. But because of this 12/31 year end, because we made an adjusting entry at the end of the period, these are 2 very different things. This interest expense we recognized last year as a debit to interest expense and a credit to interest payable, right? Whereas this interest expense has not yet been recognized because here we are in a new year. So when we pay this $4,000, what we're doing is we're paying not just the interest that we knew that we already owed them, that's already sitting on the balance sheet as interest payable, but then we're also paying them for the additional 6 months that we had not yet recognized. And so our interest payable account comes into play, as does our interest expense. This $2,000 of interest payable is this guy right here, and then the interest expense will be this guy right here. We credit our cash for 4, we debit our interest payable for 2, and we debit our interest expense for 2. So now over this 12-month window between July 1st of last year and June 30th of this year, we've had their money for an entire year. They deserve $4,000. We should pay $4,000. And what's happening? We have paid $4,000, and between the expense here and the expense here, we will have expensed $4,000 as well. So the timing is a little off, but over the long run, what do we know has got to be true? The cash that we pay out has got to be equal to the interest expense that we incur, because over the long run, all of these things have to jive. And we record our interest payment and we move on. Number 5, we've now done some of the work that we had previously been paid for. Again, as a recap, when we received cash last year, we debited cash for $15,000, and we credited not revenue, we credited unearned revenue for $15,000. That was a liability account. And so, having now done the work, what does this mean? This means that this $15,000 of unearned revenue, this $15,000 liability, is now overstated, isn't it? It shouldn't be $15,000 because we've done some of the work. We no longer owe our customers all $15,000. And of course, if we don't owe them that money anymore because we've done the work, well, what does that mean? We've done the work. That means revenue. And so for our journal entry here, we're going to recognize the fact that we no longer owe them all $15,000. We now only owe them $5,000, so that is a debit to our unearned revenue, making our liability go down, and we have got $10,000 in revenue because we have finally done the work. You'll note that there's no distinction between the revenue that we performed and billed in the same period and the revenue that we were paid for in the prior period and simply done this period. Together, what have we done? We've done $70,000 of work in the current period. Whether or not the cash got paid last year, this year, or next year is irrelevant. It's all the exact same revenue. To recognize the revenue for work paid for in 2009, and off we go. We're now going to pay a $1,000 dividend. Obviously, we're going to write a check for cash. Now, we're going to introduce a new temporary account, and this new temporary account is called dividends. Dividends, this is not a balance sheet. This is a temporary account, just like revenues and expenses. However, this is also not an income statement account. Okay? The dividend account will find its way over to the statement of retained earnings or the statement of stockholders' equity. It will not show up on the balance sheet, nor will it show up on the income statement. So when we pay our $1,000 in cash, we're going to credit our cash account for $1,000, and we can immediately put our little line here and say, well, if the other account that I need to use is this dividends account, and I've already done my credit, the only thing that's left is to debit it, right? And so we're going to debit our dividends account as part of this journal entry. Now, why are we debiting this dividends account? On the one hand, it's because the journal entry has to balance, but that's intellectually unsatisfying. The real reason why we're debiting this dividend is because debiting a dividend is reducing our owner's equity via the statement of retained earnings. That's what that says, I promise. Here, I'll cross the T for you right there. Via the statement of retained earnings. Because we have to remember what a dividend is. A dividend is saying, dear shareholders, we've made some money for you. We had revenues minus expenses is equal to net income. We've created wealth for you. And when we create wealth for you, that means your owner's equity has gone up. Now, here, have some. We're going to pay the owners of the firm some of the money that we have made them. And so, not all of the earnings of the firm have been retained within the firm. Some of them have been paid out in the form of dividends. And this is why we call it retained earnings, or why Coca-Cola calls it reinvested earnings. Some of the money gets held in the firm, and is kept in the equity section in retained earnings, some of the profits of the firm get paid out, and when they do, we're cashing in some of the chips. We're cashing the owners out of the firm. We're going to record our cash dividend payment, and we'll move to journal entry number 7. So here we are in our adjusting entries now, and our adjusting entries are going to be very similar to our adjusting entries last period, with the exception that now we've got 12 months of time having passed rather than just 6 months. And so we know that we need to use our prepaid rent account, and we need to use our rent expense account. And once again, we look at our prepaid rent, and our prepaid rent of $9,000 is for 18 months, right? That we had originally had 24 months, we used up a half a year, and now we've got 18 months left. Except now we don't, right? Now we've really only got 6 months left because we used another year during 2010. On December 31st, 2010, we've only got the upcoming 6 months ahead of us. And so what do? We reduce our prepaid rent by $6,000, and we recognize the fact that that money was used in order to generate revenue. We debit rent expense to record an expiration of a portion of our prepaid rent. Our second entry has to do with our depreciation. Again, it's the exact same thing that we did the prior period, with the exception that the timing has changed a little bit. We've got 12 months rather than only 6 months. Once again, to remind you, we had a $50,000 piece of equipment minus the $10,000 salvage. Gives us a $40,000 true cost. We expect this to last us 4 years. And so we're getting a $10,000 of expense being recognized each year, exactly the same way that we did with our prepaid rent. We're going to use our depreciation expense account, and we're going to use our accumulated depreciation account to track the reduced value of the asset on the balance sheet. Again, you will note that this guy's got an opening balance because our accumulated depreciation account is a balance sheet account. It's a permanent account, whereas our depreciation expense account is a temporary account. This gets closed into income summary and then into retained earnings. This is an income statement account. So we have to remember that our depreciation expense is an income statement. It's a temporary account. It only recognizes the current period's use of the asset, whereas our accumulated depreciation account, being a balance sheet account, being accumulated, takes into account all of the costs that we have expensed from time immemorial. The only time that these two accounts will have the same numbers in them will be the very first year of an asset. Going forward, what are we going to see? We're going to see a debit to depreciation expense for 10. We're going to see a credit to accumulated depreciation for 10, giving us an ending balance of 15. And when you look at the balance sheet, what are you going to see? We're going to see equipment of 50 minus accumulated depreciation of 15, giving us a depreciated cost of $35,000. To record the depreciation expense for the current period, and one last transaction. So here we go, recognizing our interest expense, and this entry is going to be the exact same entry that we did last year. We're going to have interest expense of 2 and interest payable of 2 to record our accrued interest expense. But Dave, why are we only doing it for 2? Haven't we had their money for the entire year? And yes, we have, but if you remember, back when we paid, we recognized the interest expense for the first 6 months of the year. So as of June 30th, we were all equal. We were all square with Mr. Bankerman. We had recognized the fact that we had paid them. We had recognized all of the expense that we had incurred, the $2,000 last year and the $2,000 this year. The only thing that we need to account for now is the additional $2,000 that we've incurred because we've had their money for an additional 6 months. What does this mean? This means that for the duration of this loan, every December 31st, we're going to do this exact same journal entry, and every June 30th, we're going to do the exact same journal entry we did before with the debit to the payable, the debit to the expense, and the credit to cash. We're now ready to close the books. And as I said before, closing the books is a completely mechanical process. We've got our revenues and our expenses. Our revenue has a credit balance. Our expenses have all got debit balances. And so we will debit our revenues and we will credit all of our expense accounts, zeroing them all out. Our journal entry doesn't balance, so we'll put Dave's magic plug box right here. And we're going to take that number and we're going to put that into our account called income summary, our holding account, just for a few moments. And we're going to credit income summary for $24,000. That is equal to our net income, the 70 minus the 26 minus the 4 minus the 6 minus the 10. Our second journal entry, our second closing entry, then takes the $24,000 in income summary and throws it into retained earnings. Again, we see retained earnings has a beginning balance because it is a balance sheet account. We're going to debit our income summary for $24,000. That zeroes that guy out. We're going to credit our retained earnings for $24,000. And so our retained earnings, our owner's equity, has now increased by $24,000 to recognize all the value that we have created for the owners throughout the period. Lastly, we come to closing entry number 3, which is a new one for us because we've got that silly dividends account sitting there. And that dividends account, being a temporary account, also needs to get closed. Closed where? Well, into retained earnings. Because while we began with $5,000 in retained earnings, and we earned an additional $24,000 for the shareholders, what did we do? We cashed them out, right? We credited cash. We gave them some of their money back. And so when we close our dividends account, we have now zeroed out our dividends account. We are going to close that into retained earnings to recognize the fact that, in fact, while we had 5,000 plus 24, a total of 29, because we cashed them out for 1, we've now got $28,000 as our ending balance. And it appears that was supposed to pop up on its own. We'll just stick that on the blooper reel to close dividends declared into retained earnings. Here's our post-closing trial balance. Again, if we totaled up all of the numbers in all of the accounts that are still open, all of our balance sheet accounts, this is where we would find ourselves. Again, you will note that these numbers do not jive with the balance sheet because this accumulated depreciation, while being in the credit column over here, lives on the balance sheet with this. And so each of these numbers are going to be $15,000 too high. Our total assets ought to be $175,000, and our total liabilities and equity will also be $175,000. The financial statements are in the rest of the packet. Go ahead and take a look at them and then get to work. This is a pretty tricky subject, and some people it takes quite a bit of time to get their heads around it. So this would be one of those places where a little bit of extra work early on will really pay off for you as the rest of the class goes along.